In recent months, almost everyone has issued inflationary warnings. People like Ray Dalio, Michael Burry, Warren Buffett, and even customers around the world have noticed an increase in inflation in practically all goods and services. Furthermore, the vast majority of investors anticipate that inflation would sharply increase in the next years. Contrarian Cathie Wood predicts deflation and thinks the opposite will happen. Instead of an inflationary crash, Cathie thinks a deflationary catastrophe will be the true black swan event. Hi. Welcome to Stock Market Mate, a channel where future billionaires and millionaires can learn how to make prudent investments. We will discuss in depth Cathie's reasoning for holding this view, as well as the evidence that supports it in this video. Before we dive into today's content, if you're new to our channel, please subscribe and hit that notification bell to get updates on our latest videos. If you're done with that, then let's get started. Cathie Wood, who started her career as an economist, has extensive knowledge to support her claims. It is crucial that we listen to Cathie without making any preconceived notions as a result. In fact, in the early 1980s, prominent economists Milton Friedman and Henry Kaufman held the view that inflation would persist. Being a relatively fresh economist, Cathie Wood, on the other hand, had beliefs that inflation was in fact slowing down. And yes, Cathie was correct in the end. This is nothing new for Cathie Wood, who is making a daring forecast against the consensus. For the first time, the money supply is causing an increase in inflation. The amount of M2 currency that is currently available has increased significantly since the start of the pandemic. Savings deposits, checks, cash, checkable deposits, money market funds, and certificates of deposit all fall under the category of M2, which is a measurement of the total amount of money in circulation in the US. It's understandable why M2 money has increased significantly as well, given that they serve as a sort of stimulus checks. On the other hand, according to Cathie Wood, the rate of growth in M2 money is fast decreasing. The increase of M2 money this year has decreased from 27% in April to just 17% in May. The bond market has witnessed a considerable uptick recently as a result of the current downturn. The yield on 10-year government bonds has decreased to about 1.5% from a peak of 1.7% in March. The bond market has risen as yields have decreased, according to the inverse correlation between bond yields and bond prices. For instance, when this happens, the bond market forecasts deflation rather than inflation. According to Cathie Wood, the increase in the money supply may be the cause of rising bond prices. The money growth rate has been reduced from 27% to just 13.8% by a factor of 2. The fictitious purchasing power of the Feds may have increased bond prices. That's not the case though. This aspect of the bond market is not new. For months, the Feds have been purchasing bonds. The Fed's purchasing power was still present when the bond yield spiked in March, showing that the central bank's purchasing power has not changed. In addition to selling some of the corporate bonds and ETFs it had acquired during the pandemic, the Feds also intend to sell other corporate bonds and ETFs. Cathie anticipated a drop in the bond market. Bond prices have nonetheless kept on rising. With the CPI numbers they have received, Cathie noted that PPI is far higher than anticipated. She said that she had anticipated a continuation of the bond market's decline and an increase in interest rates as a result. No matter how strong the economic data has been or how high the inflation rates have been, the 10-year Treasury bond yield has decreased from 1.74% to 1.43% since the end of March. In addition, Cathie noted that many people could assert that it is simply quantitative easing, which she believes was accurate at the beginning of this year and through March when they increased from 0.9% to 1.74%. However, she claims that the bond market is looking for something. Although Cathie Wood might seem mad, she believes that inflation will continue for the foreseeable future. The Personal Consumption Expenditures Price Index shows that in February, prices increased by 3.9% over the previous year, an increase of 1.6%. The month of May, according to Cathie, might see the inflation rate rise to 5%. Despite the chance that inflation would pick up during the coming few months, Cathie predicts a long-term fall in prices. In an ironic twist, deflation is being made possible by the rise in oil prices. The Organization of Petroleum Exporting Countries, or OPEC, a group of nations that regulates the oil market, is adamant about recovering some of its lost revenue by reducing oil production. These might seem illogical given the surge in energy costs. Individuals are choosing electric automobiles in greater numbers. Sales of electric vehicles, or EVs, have increased more than sales of conventional automobiles during the pandemic. The idea that electric cars are better than gas-powered cars and the increase in petrol prices both have an impact on this. More individuals being encouraged to choose electric vehicles as costs climb overall, lowering the long-term demand for oil. The price of crude oil is currently at $75 per barrel, which is not far from the recent high of $77. Cathie predicts that the cost of a barrel of crude oil will eventually drop to between $3 and $12. $3 to $12 per barrel in fact. $12 a barrel would be 84% less expensive than the current price. If these low prices become reality, there would be a substantial drop in prices. According to Cathie, of course OPEC is one of the causes. Additionally, they have a daily production capacity of around 5 million barrels. They aren't. They aim to maintain a high enough oil price to cover their budgetary needs, but at some point, demand might actually die. I do believe they will begin producing, and as you are aware, in the long run, after they start to witness demand destruction due to pricing, we predict that the combination of electric and autonomous electric vehicles will lower oil prices. This, as I've already stated, is how I see things, my point of view. The research that led to us here has not yet been completed, but I believe that we could decline, returning to the level at which oil prices were in the early 1970s, once the cartel took control. They increased from, I believe, $3 to $4 a barrel to $12. I wouldn't be shocked if we returned there in the end, especially given how rapidly electric vehicles are growing in popularity. Additionally, they have begun to take a considerable share. A further sign of deflation is the US dollar's purchasing power. The dollar index has significantly risen during the past month. This directly contradicts worries about dollar inflation because it shows that the dollar is becoming more valuable in comparison to other currencies. This might be because Biden's capital gains and company taxes were less than expected. Recently, commodities have also been declining. Cathie Wood predicted the latest drop in lumber prices years before it really happened. Other factors include copper pricing and pork prices in China, as Cathie explains in the following video. I believe that the general expectation is incorrect. At the start of this year, the dollar was the currency that most people were short. The dollar is not declining either. That also fits the unexpected decline in bond yields. Consumer demand is the last factor that we need to take into account. Real consumption dropped by 0.4% month over month. Consumption of durable goods is down 0.3% from month to month, while non-durable goods consumption is down 0.5%. However, consumption of services is only increasing month over month by 0.4%, which is smaller than the decline in consumption of goods. The expansion of the money supply and consumer spending are both slowing down, yet inflation may not be as terrible as you think. The current decline in commodity prices supports this. Many other people, including Ray Dalio and Michael Burry, believe that there will be soon a hyperinflation and that the bond market is in a bubble. And that ends our talk for today's video. What are your own thoughts about Cathie Wood's warning about the deflationary crash? Join in the conversation in our comment section below. We'd love to hear what you think. If you enjoyed today's video, do give us a thumbs up and click that subscribe button. Also hit the notification bell to get updates on our latest videos. That's all for today, and we'll see you next time. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!